Hello again, and welcome to the latest Brunsdon Investment Market Update. I'm pleased to have with me this morning Jonathan Webster-Smith, who is a Director and Head of Investments at Brooks Macdonald. Jonathan also heads up the investment team for the IFSL Brunsdon Investment Funds, and we'll be going through this morning a few questions that you're asking us at this moment in time. Welcome, Jonathan.
Hi, Brian.
Thank you for joining us. Jonathan, we have a number of questions that clients are asking us at the moment. As you can imagine, they're interesting times. And one of the key questions at the moment is, why was December such a tough time?
Well, I mean, if we look at some of the stats from December, the S&P 500 dropped over 16%, really for two reasons. One is we had some comments from the Federal Reserve raised interest rates, and that's against the expectation of the market, but the accompanying statement was also not what the market was expecting. We've also had a dry up in liquidity, particularly around the dollar, and the combination of that plus a weakening fundamentals has unfortunately affected not just the US equity market, but the vast majority of risk assets for 2018 and culminated in what was a pretty poor month all round.
Okay. Funds in 2018, which funds performed well and which ones didn't?
Given my previous comments, the more defensive type funds clearly performed better overall, focusing just around the equity funds and the divergence that we saw there. The more growth-orientated funds with more predictable earnings did significantly better. The more value-based, where the earnings aren't quite so certain, underperformed, and particularly in that final quarter in December in particular. And really for a pickup on those asset classes, we do need a clarification about the global outlook, which at the moment the sentiment is moving slightly more negative, and that again had the impact. So we'll wait to see what happens for next year.
Okay, and talking about next year, 2019, here we are now. How do you see things going?
Well, I mean there's a few things that would definitely need some clarification on. One is the positioning of the Federal Reserve. So they have softened their rhetoric in early January from December, and that's been a positive. We're also having some positive tweets, shall I say, in respect to the US and China trade war, and certainly if we get a clarification of that, plus the Federal Reserve starts looking more at the data and perhaps, dare I say it, ceases their interest rate movements, then we could have some more upside potentially to the equity market. The question is whether, and here we're looking particularly at inverted yield curve, things like that, which will give us a clue as to when the US is going into a recession, at which stage obviously we'll have to look again at our equity positions, but certainly the fundamentals and growth seem to be, and the risk seem to be more to the downside. So we're certainly taking out some of so we're taking a precautionary move and taking some of our equity, but we still will hold a significant part because corporate earnings remain strong. Fundamentals there's not all negative, and I think there's potentially some upside from particular sectors. So it's going to be a very difficult, I think it'll be a volatile year, but hopefully one that ultimately creates some opportunity for us to take advantage of.
Okay, let's talk about Brexit. How does Brexit affect the Brunsdon funds?
Well, that's the $1 million question. We don't try to guess into the politics here, so we're simply looking at, from a fundamental point of view, what could the outcomes be and what impact would they have. It's fair to say that the UK was lagged last year. We have an underweight position, so that in itself is a positive from that side of things. The effects will be felt largely, I believe, around the currency. So if we were to exit, and I'm not here making any predictions, but if we were to exit with a no-deal type scenario, I believe we would expect to see a weakening of sterling. That perversely is actually positive for our international equities, who would benefit from that weakness as they did in 2016. So again, even no deal, it's not all bad. The perfect deal would see the strengthening of sterling, and the inverse would probably happen. And somewhere between the two, you would think that sterling is largely priced into that. We have seen estimates that a no deal would force a longer term contraction in the UK economy, taking growth down to sub 1%, and a perfect access to the European markets would probably see it come down just very, very modestly. So those are economists. They're liable to be wrong. But again, my view is it will be felt first in the currency market, and actually there's some things we could take advantage of there.
Thanks for that, Jonathan. A number of clients ask us with regard to the economic cycle where indeed we might be at the moment, both the US, of course, which tends to drive things, through to the UK. Wonder what your thoughts are on that, please.
I mean, in terms of cycles, different economies here are at different stages of the cycle. Where we've spoken a lot about the US, given the falls that we saw in December, and that is, most definitely in late cycle. We're talking about potentially when the US, or indeed if the US goes into recession. At the moment, we see the probability being relatively low in the short term, but that, we're talking the next 12 to 24 months, that clearly there is a higher probability for 12 to 24 months, but that's one we have to wait and see. China is at a different stage, in its cycle, and we're talking about the stimulus that they're putting into the marketplace. And I would say the UK and Europe are behind the US in terms of they are stopping or have stopped quantitative easing, but really at the early stage of putting interest rates up. So again, I would describe them as late cycle, but a bit further back than the US.
Thank you. And thank you for watching. I hope that was useful and informative. As always, if you have any questions, then please be in touch with us, and see you next time.